Managerial accounting is the field of accounting that gives information to internal decision makers. There are three main functions of managerial accounting. First is the planning function. This is choosing goals and then deciding how to achieve them. To do this, managers have to look to the future and establish goals. Planning can be done strategically or operationally. Strategic plans are often long-term plans that often spans at least 3 to 5 years. Operational planning focuses on the short term and deals with day-to-day operations. These are usually a year, but could also be a month or a week. Second is the directing function. This involves running day-to-day operations, which can include purchasing, manufacturing, and selling. Managers are also responsible for motivating employees. Third is the controlling function. And this is monitoring day-to-day operations and keeping the company on track. This involves comparing actual results to expected results, such as the actual cost to the expected cost in order to evaluate performances. If the actual cost is below the expected cost, that is good news. If the actual cost is more than the expected cost, managers will have to evaluate the results and make any needed changes. Decision-making is part of all three functions. Good decision-making can be the key to a successful business. And now we will look at how costs are classified under managerial accounting. Businesses are generally classified as service, merchandising, or manufacturing companies. Different types of businesses classify their costs differently. Service companies sell their time, their skills, and their knowledge. Merchandising companies resell products they purchase from suppliers. These managers are responsible for purchasing, storage, and sale of products. Manufacturing companies, however, use labor, equipment, supplies, and facilities to convert raw materials into finished products. This is the type of company we will be focusing on. These managers must create a product that customers want and at a price they are willing to pay. Manufacturing companies use three kinds of inventory. Raw materials inventory, which is the materials used to make the products. Work in process inventory, which is goods that are being manufactured but are not yet complete. And finished goods inventory, which is the completed goods that have not yet been sold. This is what the manufacturers will sell. Manufacturing companies classify costs into three categories. Direct materials are the cost of raw materials that are made into the final product. These are easily traced to the product. Direct labor is the wages and salaries paid to employees who make the raw materials into the finished product. This is also easily traceable. Manufacturing overhead is the indirect manufacturing costs that cannot be easily traced to specific products. These costs are all costs that aren't direct materials or direct labor. These can include storing materials, setting up machines, and cleaning up the work areas. Other overhead costs would be salaries of managers, janitors, and groundskeepers. Repair and maintenance, and the salaries of the people doing it. And the depreciation on buildings and equipment. Managers can combine costs in different ways to help them better evaluate the current situation. They can be classified as either prime or conversion costs. Prime costs combine direct material costs with direct labor costs. In labor-intensive manufacturing, where people do most of the work, not machines, the direct costs are the primary costs. In this type of manufacturing, managers will want to focus on controlling these direct costs. Conversion costs combine direct labor with manufacturing overhead. Another way to classify costs is product costs and period costs. Product costs are costs from purchasing or making a product. Direct materials, direct labor, and manufacturing overhead are all product costs. These are recorded as assets and become an expense when the inventory is sold. Period costs are selling and administrative expenses and other expenses such as salaries of the accounting staff, sales commission paid to sales reps, or rent on an office building. These costs are matched with the revenue of a specific time period and expense in the same accounting period. Period costs are non-manufacturing costs. Thank you for watching.